In this episode, we are thrilled to welcome Frank Colombo from Viridian Capital Advisors. He is one of the most trusted names in cannabis investment. People read his newsletter, they analyze MSOs, they look at broad investments, they look at the market, all because of the insights that Frank and his team have at Viridian. That's enough of that. Let's dive into it. Welcome, Frank. Frank, I think one of the main issues that everyone in cannabis is keenly aware of and that you and Viridian have written on extensively is the debt that's maturing in 2026 for the cannabis industry. Can you break down why this is important, who it affects, and what kind of the implications are for the industry as a whole?
Sure. The good news here is that it's less of a problem than it was at the beginning of the year. At the beginning of the year, we were looking at something like $2.5 billion worth of debt maturing, which is more than what the cannabis industry raised in any year, except for in 2021. So it looked like it was like, oh my God, how could we possibly do this? And as you look at it, there are obviously companies that look like they're easier jobs to refinance and companies that are tougher. And it just so happens that the ones that look like a real threat, like how are they going to get this done? It's already been resolved in one way or another. So, for instance, Gold Flora went into receivership. Forefront went into receivership. Air, which looked like it was the toughest case of all, they're doing this Article 9 UCC credit bid system, which has become the new kind of thing, which Schwaz is also pursuing. And then finally you have cannabis, which might have been, maybe it will turn out historically to be the last of the extend and pretend, just kick the can down the road kind of moves that we'll ever see. Maybe. Maybe somebody else will do it, but they resolved their problems. So now what you have left is you've got a big block of $1 billion of that's composed of Trulieve, Cureleaf, and Verano, and all of those look pretty decent to me. I think they'll be able to refinance. The two that look a little bit tougher are Jushi and Ianthus, and those two add up to something like $289 million. So, you got a $1 billion that looks good, 289 that looks a little bit dicier. But in any case, it's not going to turn out to be the systematic risk kind of thing that people were worried about.
It's a fascinating place to kind of look at our industry and see that there is all this debt out there. When you look at it from some of your clients, Frank, and you analyze this situation, what kind of risks, beyond the obvious of kind of these companies going into receivership, what risks and also what kind of opportunities do you see for the kinds of clients that you and Viridian have in this scenario for going into 2026?
Well, obviously it depends a lot on what happens on the legislative front. If you look at the cash flows of all the public companies, 280E is a big deal. And, it gives them a lot of excess cash flow if they don't have to pay 280E. And most of the major MSOs, all of the big guys, except for GTI, have elected to not pay it. They're just accruing it. We can talk more about that. But smaller private companies, a lot of the guys we deal with are smaller private companies, and they're actually paying their 280E bill. And it's painful. They're not, just accruing it like the big public companies. And so, from a smaller private company point of view, having 280E go away is a lifeboat. It gives them a tremendous boost in their cash flow that they can use to, invest in their operations, or, just gives them a little bit more leeway so they don't have to worry about making payroll. So it's that legislative on-off switch is very key. I think the other thing that is being thrown around a lot is this, banking reform, SAFER, which could also be a major thing. In fact, I think it's actually more important in the end than rescheduling, because it opens the door to not just bank debt, because, I don't think that's the most important part of SAFER. The most important part of SAFER is that banks will start to be able to custody stocks, and that will open the door, not immediately, but pretty quickly, to uplisting of stocks to kind of the NASDAQ and NYSE, New York Stock Exchange. That will be a big valuation gap. That will also be what it takes to bring more institutional investors into this business. That kind of good housekeeping stamp of approval that, it's okay for the banks to deal with this industry. Therefore, it's okay for me to deal with it as well as an institutional investor. So I think those two things are pretty critical looking into 26.
Let's unpack something for some of our listeners. I mentioned, Frank, we have a very interesting mix of listeners here. You mentioned that the larger MSOs are accruing their 280. I operate a grow out here in Arizona. 280 kills me every month. Explain what they're doing and how they're getting away with what they're doing as it relates to 280 for some of us who are smaller that obviously don't have that opportunity.
Sure. I mean, fundamentally, let's just put it this way. You get a tax bill. You dispute it. It goes into tax court. And it's only when the ruling comes through the tax court that, yes, you really owe this, that you really do absolutely owe it. Until then, there's always a little uncertainty as to exactly how much you owe. And, appealing tax bills is very common. But this is a special case where most of the MSOs have gone to their legal teams and they've come up with various arguments for why 280E might not be related to them at all. And a lot of that relates to kind of like the argument is that state legalization of medical programs should have immediately removed 280 cannabis from Schedule 1, because the states are all saying that it's medically legal, and these companies are operating within state silos, one state or another state, and so they're arguing that should have retroactively eliminated 280E. That's one of the arguments. But the idea is they are recognizing in their financial statements an expense. They are actually booking the tax expense in their income statement. But what they're just doing is they're not paying it. They're building a liability on their balance sheet that says, chances are we owe this, but we're not paying it now because we don't know exactly how much we owe. We don't know when we owe it. We don't know. There's uncertainty, which is why these things are called uncertain tax liabilities. And so if you look at the majors out there, these things are huge. In fact, at this point, they are bigger in terms of liabilities than these maturing debts. And so it kind of depends, how do they get worked out in the end, and most legal opinion that I've seen says that, they don't retroactively just go away. Even if 280E goes away today, you still have these liabilities from the past. And how do they go away? And it's unclear. They probably don't all of a sudden just come due tomorrow, because that would be devastating. And I don't think that, it's not the IRS's benefit to try and push these companies into insolvency or anything by saying you have $500 million due right now. So it's not likely to be the case, but that's how they get created, why they get created. And the big if is, how are they going to go away? And nobody really knows exactly how they will all be worked out. So does that answer your question?
Yeah, that is a significant, I would say, liability. I mean, from an investor perspective, how much does that worry you? The uncertainty of that continual accrual of this tax liability?
Well, I mean, there's a couple ways to look at it. On the cash flow statements of these companies, you will see a cash flow from operations line, which is positive for almost all the big guys. But then when you look part of that cash flow from operations is an add back of the amount in that period that they didn't pay for these tax liabilities. The increase in that liability is listed very specifically right on their cash flow statement. And for a lot of them, it's a very significant part of their cash from operations. So like their cash from operations would be much less if they were actually paying these liabilities. So there is that. Now, from my point of view, and I think a lot of the big debt investors out there, you can talk to Chicago Atlantic, for instance, and they will tell you that when I look at liabilities or debt for these companies, I include that. So I basically include all these tax liabilities as though they're debt, and so that influences, how strong a credit I view them as being, because when you include them as debt, obviously, all of a sudden these companies have a lot more debt than what they, look if you don't include them as debt. So I am not particularly worried about them, because if you look at, I look at it a couple of different ways. I look at these liabilities compared to the market cap of the company. And for most of these companies, there's only two of them where the tax liabilities are more than their entire market cap, and that's Ascend and Ianthus, and they're like 100 and 110% of market cap. And Jushi is kind of close; it's like 98% of their market cap. So those are the really big ones in terms of the size of the company. Then you can also look at it versus EBITDA and say, how big are these liabilities versus 1 year's worth of EBITDA? And, generally speaking, they're relatively small, but there's some that aren't. And like Jushi, their tax liability, uncertain tax liabilities, is over 300% of their annual EBITDA. So, it's a significant thing. And to me, it does come into my ranking of credit, because one of the things I look at is total liabilities compared to market cap, or a ratio that I would encourage, anybody to look at as a key credit ratio. And it's obviously included there. And so it does influence my ranking of credits.
You led into my next question, Frank. For those of us, or for those people out there who are listening, walk us through your ranking system. What signals high credit? What signals weak credit? What are you and your team looking for?
Sure. I mean, I started this credit scoring system, about 6 years ago, and it was a time where a lot of the companies that I ranked, didn't even have positive EBITDA. And so, from a, old school credit kind of point of view, it's like, well, how do you rate the credit of somebody who has no EBITDA? And, you can't calculate a interest coverage ratio, and you can't really calculate a debt to EBITDA if its EBITDA is negative. So how do you do it? And so I had to rethink credit from kind of a fundamental ground up point of view. And so when I thought through it, I thought, well, there's really these kind of 4 aspects of credit that I want to build into my model. And one very fundamental one is liquidity. Do they have enough cash to pay their bills on an ongoing basis? That's pretty fundamental. So I measure that a couple of different ways, and one of which is kind of a new kind of ratio that I made up, where I take like the standard current ratio that every finance student learns, and I modify it by taking into account how much free cash flow or negative free cash flow these companies have, and use that to build kind of a new current ratio. And it's powerful, because if that ratio is less than 1, it basically tells me that's a company that is probably going to have to raise more money in order to pay their bills this year. So that's how liquidity is pretty important. Leverage is another important thing. Pretty much every credit handbook will tell you that, the higher a leverage is, the more debt compared to earnings or compared to size, whatever. And I measure that a bunch of different ways. You can look at leverage a number of different ways. You can look at balance sheet leverage, like debt to capital. You can look at cash flow leverage, like debt to funds from operation. You can look at market leverage, which I like a lot. You can look at liabilities compared to market cap. So I basically have about 5 leverage ratios that all get assimilated by my model into one leverage score. And then there's finally profitability. Now, profitability sounds like it should be really important, but it's kind of a slow burn kind of idea. You can be unprofitable for a lot of years before your balance sheet deteriorates to the point where you're really in danger of defaulting. And a classic example is, Canopy Growth. They have 12 straight quarters of negative EBITDA, so it's like a melting ice cube, but it takes a long time to melt. So profitability is a ratio, and I measure that by 2 or 3 different measures that go into a profitability score. And finally, I measure size, because like in almost every other thing, size matters, right? Bigger companies, everything else being equal, are better credits. And why is that? Because, they probably have more ancillary assets that they could sell off if they needed to. So that's one good thing. They've been around longer, so they probably have more established business relationships. They also tend to be more diverse. They've been around longer, so they expanded into different markets. They have different markets, so it's diversification. There's a lot of reasons why size is correlated with credit strength. So my model basically builds indicators for each of those 4 factors, and then it assimilates those 4 factors into an overall credit score. So, a company that has a lot of liquidity and low leverage and is really profitable and is big, that's the best credit you can get. And GTI is that. It's the number 1 credit. Since I've built this model, it's always showed up as the number 1 credit. Number 2 and 3 and 4 kind of jump around. Right now, I'm showing Trueleaf as the second best, and Glasshouse, strangely, a lot of people would think I'm crazy for that, but Glasshouse is showing up as number 3 right now. And so that's how I do it. I am going to build in some more qualitative factors, and I talked about that a couple newsletters ago. I think the kind of qualitative factors that are important that you also want to look at but aren't numerically scored in my model right now but will be, is things like, have they had a recent management change? Their CFO just left. That's not a good sign. Big surprise, right? Did they just change their auditors? Well, there's good reasons for changing your auditors sometimes, but it's a warning sign. You want to know, why did they change their auditors? Did they file late financial statements? There's another qualitative thing that is a big warning sign. When companies start to file late, I want to know why. What happened that they couldn't get their financials filed on time? So there's these qualitative things that I look at that I am trying to build numerically into the model, but I haven't done it yet.
Gotcha. Well, this, again, somehow, Frank, you dovetailed my next question. I know so many people who are interested in your newsletter, what Viridian's saying, when they're saying it. When did you realize that there was a significant opportunity for this kind of analysis in our space? Because I feel like all of a sudden everyone's talking about Viridian and kind of, your analysis, your newsletter, and your publications.
Well, the Viridian credit tracker has been going ever since, 2015. So it's been going a very long time, reporting on transactions that have happened in the market. That's what the original tracker was built as, to kind of report on what deals happen, debt, equity raises, debt raises, M&A deals. So the basic newsletter has been going for a very long time. When I came to Viridian 5 years ago, I brought with me kind of a skill set of credit and analysis, kind of valuation, credit analysis. And so I built some some bigger valuation things into the model. So I've got a valuation template which allows me to like filter by any kind of thing and say, how are these companies valued, whether it's by sector of the market, by what state they're in, how big they are, whatever. So that and credit, credit was something that I've always been involved with for my whole career. And I ran high yield research at UBS for a while, and went down into distressed at Seaport. So I started thinking from the very beginning, there is no credit ratings in cannabis. None of the big credit rating agencies rate cannabis. And it has to do with what I talked about banking reform. When that happens, they may start rating credit. But it's really been, kind of gradually and increasing over the course of the last 5 years that we've kind of built more tools, started looking at things a little bit differently. Lately I've been using option models a lot to try and, evaluate how much asset coverage companies have. There's various new tools. I basically try and look at my toolkit from academia, business school, and from my credit background, and try and say, well, how is this applicable to cannabis, and why is nobody else looking at this? And, kind of a classic example of that is return on invested capital. I've not seen anybody else publish on return on invested capital. And meanwhile, in what I call the real world, which is outside of cannabis, it's something that every industry focuses on. I mean, it's not a surprise that everybody focuses on that metric. And so that's something that, classic finance valuation theory, teaches you, it's to focus on. And yet, cannabis is kind of been an island where, it's changed a lot over the last 3 years, where there's a lot more professional research happening mostly on the buy side, because the sell side research is kind of like almost gone away. It hasn't gone away, but it's dwindled. But the kind of sophistication that buy side funds are bringing to looking at these companies has gone up and up and up, and it will continue to.
Frank, given what we've been discussing, you've talked a little bit about some of the positive things you're seeing. Can you give us an insight into those companies? You kind of touched on it, but what are those companies that are concerning you right now looking into 2026? What are those companies that we all know, whether we're operators, investors, executives, which companies are giving you pause right now?
Well, I mean, profitability wise, I think Planet 13 is not showing up as being highly profitable. And so when I looked at this ROIC graph that I just published this last week, they're the only ones that are to the left of the negative. They're the only ones with negative operating projected income for 26. So obviously, somebody that's not profitable is a concern. And I think I focus a lot on this ratio that I think I would advise everybody to start looking at if you don't, which is total liabilities to market cap. Okay. And I didn't make up this ratio. A variation of it goes way back in history. It's part of the Altman Z-score bankruptcy prediction model from 1968, and Drexel Burnham used a version of this ratio when they analyzed junk bonds back in the 80s. And so, I picked it up, but the importance of it is that you can map that ratio over into something that means more for most people, which is, what is the market value of this company's assets compared to their liabilities? Are their liabilities really covered or not? And you can, using option modeling, and I don't want to get into the details, you can read in our newsletter, but you can make that mapping. And so to me, if you want to look at, what companies are starting to look dangerous. So that's the ratio that you want to look at, and if you just pull that up and say, what I've found over time, incidentally, is that when that ratio starts to go over around 5 times, it's kind of my first level of warning. So, and when it goes over 10 times, it's like flashing, red lights really heavily. So, I don't think it's much of a secret to many people that tilt is, not looking good. Their number right now is like 130 on that. So they work fairly bad. Vibe Growth is another company that's very high on that. It's 39. Now Body and Mind is another company that's over 10 times. Eanthus is starting to get up there at around 7 times. Now, what I want to caution people in is you look at that ratio and that says compared to what the market thinks you are heavily levered. So Cannabis is another company that's way up there, right? 12 times. Now, the reason why I want to caution people is that doesn't mean that these companies are about ready to default. There has to be some kind of a trigger. Is there a big debt maturity? Is there a big interest payment? Do they have to pay something? And with regards to, for instance, Cannabis, they just pushed all their maturities way out to 28 and 29. So I don't see that trigger. What it's telling me is if they had to refinance today, they would have a problem, probably. And so, those companies that I just mentioned are companies that are kind of far up on that ratio already. Now, when you look at Planet 13, though, I told you they are one of the few in my recent work that showed up as having negative projected operating income. But on that ratio, they look great. I mean, they're only 1.3 times. So I don't think there's any imminent, default risk with Planet 13, but it's something worth watching. Can they turn around the profitability picture or not? And, they kind of like dove headlong into Florida at an inopportune time, let's say, as you will recognize. I think those are the primary ones.
And when you look at the industry as a whole, Frank, right now, we are in a very, almost call it in-between time. I was just talking with Jeremy Burke from Business Insider Cultivated. I guess my question for you is this. I'm sure you get this a ton. And someone who's not familiar with our industry comes to you, dinner party or business-wise, and says, Frank, I'm interested in cannabis. What should I be doing? I, as someone who lives and breathes cannabis, I have a hard time with that answer, especially with the state of stocks, with the state of opportunities. What kind of a elevator pitch do you give people about the state of cannabis right now?
That's a great question, and I one that I avoid mostly. But what I would say is I believe that there's a high likelihood, and everybody who's ever said this has been wrong, so take it for what it's worth. But I do think that there's a pretty good likelihood of positive regulatory catalysts. And when you look at where, for instance, I look at the aggregate valuation multiples. I look at, for instance, I take all the top 11 companies, I add their enterprise value together, and I add their EBITDA together, and I look their projected next year EBITDA, and I look at that multiple. And, to me, it's really fascinating because that valuation multiple today, or at least as of, last week, was lower than what it was on August 25th, 2023, which was the Friday before the Monday that the Housing and Health Services announced their support for rescheduling. So I think that's really telling, which is, we're now at 5.82 times, And that Friday before rescheduling was ever announced, we were at 6.48 times. So that tells me that there's a little bit of a cushion here. There's a little bit of a safety lever because we're trading below we were before rescheduling was ever really a gleam in people's eye, So, we're trading lower than that. And to me, that's a really healthy sign because it shows healthy skepticism on the part of investors that, I call it being Schumered. We've been Schumered so many times. And hopefully you know what I mean. For those of you who don't, Senator Schumer promised rescheduling, promised regulatory reform 100 times, and it never happened. And we won't talk about motivation, but it never happened. So people are very sensitive to this idea that are we being Schumered again? And so the multiples are reflected. The valuation is reflected. So I think there is it's a pretty exciting possibility that you'll see a pretty significant, 80% kind of significant pop in these valuation multiples. If, as I hope, we hear a rescheduling. So I think that is gives me a lot of comfort in what is otherwise a macro environment that is not particularly comforting. I think, that it's become clear to everyone at this point that, wholesale price compression is not something that affects one market or another market. It affects every market. And if it hasn't yet, it will. And it's not going away. And it's part of the part and parcel of being in an industry which at its base is an agricultural commodity, so, it is, it's not going away. So that has been pressuring revenues and margins for a while now. It really came into the vocabulary though, in 2022. You go back before 2022, you don't see that in any of the earnings calls, any reference to wholesale price comp. And now it's in every, you can't escape that term. So, this whole idea that I've come out with, which ROICs are too low, also relates to another factor, which is, people complain about the lack of capital access in the industry. But I would look at it the other way around. I would say there's too much capital in this industry relative to the revenue it's generating. And that's because of where we're at regulatorily. You have to have a grow in New York if you're going to sell in New York. You have to have one in Illinois if you're going to sell in Illinois. Well, really, does that make sense in any kind of long-term economic point of view? Of course it doesn't. Nobody in their right mind would grow cannabis in New York. High energy costs, high labor costs, high land costs, you name it, bad weather, so nobody would do that. So in the end of the day, the writing is pretty clear that you're going to have centralized manufacturing, centralized production, centralized distribution, and that will allow people to be more efficient in their use of capital. So that's in the future. It's going to happen, but it's going to take regulatory reform to let it happen. And that's one that's going to take more time. But in the short run, I think you see companies kind of moving in that direction because you see, for instance, Cresco said, we're shutting down California. We're out of California. We sold Arizona. And so why did they do that? Curaleaf basically exited almost all the Western states. Why did they do that? Because they're basically, the mantra now is depth rather than breadth. We want to be big enough in a market so that we can get these kind of economies of scale, so that our capital is really producing the kind of revenue that it should be. So I think companies are onto that now. Companies have flashed to that, and so they're making these kind of moves that won't fully be capable of doing until we have interstate commerce, which, Who knows when that will be? And frankly, it's a good thing because I don't think that the industry isn't really ready for it right now. It would be tremendously disruptive if you just turned the switch and said, "Okay, interstate commerce, go." It would be a bloodbath.
Nightmarish, absolutely nightmarish from an operator perspective for sure out here in Arizona. You brought up a couple interesting points. I want to dial in kind of one of them. You mentioned you've been doing this credit research a long time. We talk a lot about the wholesale price compression that you brought up. It's been brutal. We see people going under left and right. Were there any other distressed sectors that kind of give us, in terms of distressed sectors that you've worked with, that give us an idea of more of those expectations about what we can have going forward?
Sure. I mean, one thing that I think, people ought to look at is an academic research, which is Michael Porter. Michael Porter wrote a book eons ago called Competitive Strategy, in which he talked about these 5 forces of competition. And, so what it allows you to do is to look at different industries on a more fundamental basis. So, for instance, what are the substitutes? Are there substitute products available? In cannabis, there's perfect substitutes, right? That's the illicit market. That's a perfect substitute. There's the hemp business. There's another substitute. Is it a commodity product? By and large, I'm not saying that it's all commodity or that there aren't brands and, they will develop, but by and large, it's a commodity product. So commodity product, high level of substitutes, high fixed cost, exit barriers. It's hard to get out of the industry once you're in because, you've got this grow in Arizona. Who are you going to sell it to if you want to get out of the industry? You're going to sell it to another person who wants to be in the industry. But if you can't make it work, why are they going to be able to make it? So it's tough to get out of the industry. High fixed costs, capital intensive, all these factors play into price competition. So when you see in any industry somebody that has all those things together going, you're going to see brutal price competition every single time. And so a classic example of that is airlines, right? Airlines, commodity product. Do you really care whether you're flying on Delta or United? No, you don't. It's a seat. It's the same as everybody else's seat. So it's a commodity product. It's a perishable commodity product like cannabis, because if you don't sell the seed today, you'll never sell it. You can't ever sell it. So it's perishable commodity. High fixed costs. Like what extra cost does the airline have for you to be in that seat versus it being vacant? A couple bags of peanuts and a gallon of gas, right? So very little. And it is high exit barriers. You want to get out of airlines. What do? You're in Arizona, there's like 1,000 planes stranded out there in the middle of the desert because what do people do with them? So airlines is a great example of industry that has a lot of the same kind of structural issues as cannabis has. And it showed up in the sense of horrible credit history. Like every major airline that you can name has gone bankrupt and come out of it. But now they're doing a little bit better. And why is that? And here's segue to cannabis. Why is that? One word: consolidation. There are a lot fewer little discount airlines floating around, and Spirit may be the last of them. Who knows? It seems to be going away. But as you condense the number of operators, you start to get kind of oligopolistic kind of pricing happening. And you'll start to see, condensation of there will always be a ton of little craft growers. And, they may occupy that premium, side of the market. There'll be fewer but bigger mainline producers who produce, great volume, probably a la Glass House, mostly in mixed light greenhouse kind of thing. So as you condense, the price competition will start to get modified. It'll start to get mitigated. So the other thing that I think happens is as you start to see separation out where you have the little regional airlines, you have the big airlines, and so they have different operating cost structures that allow them to survive in their niche, and I think studying kind of like these industries on a kind of more fundamental forces, what's driving the competition is a really useful thing if you want to look far enough out in the future to say, like, how will this all shake out when it does shake out, whatever time period that is. Nobody knows. But, the other thing I think we can kind of look forward to is on the financial side. How does cannabis develop? The financing of cannabis, and there I think you can look a lot to the high yield market. That's where I came from, and basically one of my tenets, one of my beliefs is everything that ever happened in the high yield market will happen in cannabis. And importantly, there's a few things that are important in that regard. One is tradability of assets. And when I first got into banking in high yield, bank loans weren't nearly as liquid. And they started to get more liquid because they became standardized. So standardized credit documents that allow more trading of bank debt. People like Chicago Atlantic are already well along the way of doing that, but, it has a ways to go. The other thing that I think is interesting and is definitely going to happen in cannabis, it's already long down the road in high yield, is two things: derivatives. Things like credit derivatives, credit default swaps will come into cannabis. There's no doubt about it in my mind, because it's an insurance business, right? It allows creditors to insure their holdings, or on the other side, people to speculate. So, I always think, there should be every bet under the sun that you as an investor can take. You want to short something, you ought to be able to do that. You want to go long, you want to be able to do that. You want to be able to do a levered short or a levered long, you should be able to do that. There's a market for everything. And right now there isn't in cannabis because there isn't that derivative business. And once you get derivatives and credit ratings, the other thing that is definitely going to happen in cannabis, already there was one of them, but then no follow through, is securitizations. There's no reason, every kind of asset that you can name has become part of a securitization, whether it's rock and roll royalties or, car loans or, practically everything. And it's just this realization that cash is cash, right? It's like if we have a flow of cash coming off a cannabis loan portfolio or coming off of any place else for that matter, we can take that stream of cash and chop it up any way we want, and so we can create AAA securities through securitizations. So could there be a cannabis-backed bond that's rated AAA? Of course, there's no reason why not. But it, of course, has not happened. But so I see, a lot of kind of exciting developments in cannabis finance in the future. There's two others, and I'll shut up. Right now, cannabis companies have to hold a lot of cash on their balance sheet. And the reason why they do, if you think about it, much more so than traditional American companies, because most American companies don't get their liquidity by just having a bunch of cash. They get their liquidity because they have a standby revolving credit with a bank. And that's my standby revolver almost never gets used. It just sits there. They have a committed revolver. They don't even use it, but it's there in case of a rainy day. And it substitutes for the need of having a ton of cash. So revolving credit agreements, You do see some asset-based lending, revolving credit agreements, but not nearly enough. And then the last thing is longer maturities. Typical junk bonds are 7 or 10 years long. There's nothing like that in cannabis. Like if you get a 5-year loan, it's like, yippee, we got a 5-year loan. Everybody's like, wow, that's great. Well, it really isn't. And what it does in cannabis, it has this negative impact, which is that, you have 3-year loans. Every 3 years, there's this drama like we were talking about in 2026. Will we be able to refinance it? Will we be able to refinance it? And it's disruptive, right? I mean, nobody wants to worry about having to refinance a big part of their cap structure every 3 years. So, to the point where you start to be able to issue longer term debt obligations, that'll be a very positive thing for cannabis. And it'll happen. It will happen. It's just a question of how long does it take before kind of like, and what it really takes is for some of the regulatory uncertainty to be kind of resolved.
Yeah, and nobody wants to be in the business of predicting that anymore. It's very difficult. But I want to give you credit, Frank. That analysis with airlines was fascinating. I had never thought that I would sit and look at my grow, and I'm going to go in there now and envision a bunch of planes. But I thought that's a fascinating kind of comparison for us, to look at where we might be going.
Yeah, I mean, it's all Michael Porter competitive strategy. So it's, a book that everybody ought to have on their shelf. And, it's just a very powerful way. When I was in high yield, and assigning analysts to different industries, I basically said, this is where you start to understand industry risk. It's the fundamental background behind industry risk, because it's all these forces that are operating on any industry. And there's 5 of them, and they're, some of them, they differ by industry, but it's really a useful tool to kind of look at industry risk.
It's a fascinating prism. My last question for you, Frank, because I would be remiss if I didn't give you a chance to give us something. What's your big, bold, either idea or prediction for 26 in our space? What's something that maybe you don't have to be 100% confident, but maybe something that, you want to hang your hat on looking at 26?
I think, 26 will be a turnaround year for cannabis. And I say that because I think, if you say what really pushes revenue growth and what really pushes a recovery in margins, and the answer is the same to both of those, which is new states. Okay, and I think there's a pretty strong chance. First off, Virginia, the governor of Virginia switches over in 26. They've already passed adult rec, but they've never put it into effect because of the governor. He's vetoed it every time. That'll change. I think Virginia will become a real cannabis market, and it's a big population state. Pennsylvania by then is likely to turn around. Once again, another major population state. Texas, strangely enough, nobody's ever going to predict that they go fully adult rec, but they are starting to ease up on their medical program. It's still a ridiculous number. They went from 3 to 15 dispensaries for a population that's, enormous. So, but it's progress. And once again, Florida could potentially turn rec. I think Florida, in essence, is already rec. Because when you look at a market that's been medical for that long and has all the diagnostic codes, once you get critical or chronic pain as a diagnosis, then you've opened up the floodgates, right? Everybody, even 10 years younger than me has chronic pain, right? So we can all say that. So, once you have all the form factors, including, flower, and you have the diagnosis of chronic pain, you're already wrecked. So I don't think the pop will be as big as what people might think with Florida, but it still will be a pop. So there's that. But my other less hopeful thing is I think that, I don't see California like pulling itself together. I mean, I think that the political climate in California is practically like, I don't want to say hopeless, but it is. I don't see it turning around in 2026. So you're going to have at least one major market that should be huge, much bigger than it is, that won't be. New York, nobody who's ever underestimated New York has proved to be wrong. But, I think New York shows signs that they get it, that they understand that it's really about this rollout of dispensaries, that you have, that rollout of dispensaries drives legal demand. And they seem to get it. So I think New York is going to continue on the path of progress towards, being a top 5 market. And I think it will be. By 2026, it should be one of the top 5 markets in the country. The big unknown that I don't know how to bet on is what happens with hemp. Right now, the direction that, federally and in most of the states seems to be like crack down on hemp. That's bad. Hemp's bad.
Right.
I think that it's really disingenuous for the most part, because I think, so many of the adult legal states are really cracking down, and it's fairly transparent that they're really just trying to protect their endogenous legal market. So
right.
Even though it's couched in terms of like protecting people from untested, bad stuff, it's really not. I mean, it's more.
It's like, come play by our rules, and then you can play.
And so to me, this is a little controversial, but if you look at the illicit market and the hemp market and put them together, size-wise, what you have when you do that is something that is much bigger than the legal market, maybe twice as big. And that should tell you something. It tells you that there is a tremendous number of customers out there who are price sensitive, so they value the fact that they can buy it cheaper. They are convenience sensitive, so they like the fact that they can go to a smoke shop and buy something that'll work for them. And they don't care, or at least they're willing to bargain away the perceived safety of like seed to sale tracing, so they know exactly where everything came from, or like huge amount of testing. They're willing to bargain that away. Why? Okay, if it's so important, why are there so many people who don't care? And what I would argue is that in the end of the day, cannabis is tremendously over-tested. It doesn't need to be tested as high as it is. If you look at alcohol, ingredient-wise, testing to make sure there's not like a huge amount of pesticides in there, that might be something good. But do you need a COA on every bottle to get there? No, you don't. And it's kind of stupid in my view. So, I think, this is not next year or 2026, but there's got to be kind of a happy medium between the Wild West of like, THCA through the mail, which, I've actually done. I mean, you can order THCA, pay for it on your credit card, which you can't do with cannabis, have it delivered to your door, which you can't, and so there's something in between that Wild West and the over-tested, over-regulated market. So I think we're kind of doing a disservice to say, pull it into our over-tested framework, rather than arguing that maybe we should be less regulated, less, kind of the middle ground isn't all the way coming to us. It's somewhere in the middle. And, that's the rational position. It doesn't seem to be there. I can't point to hardly any place where that is happening. So it may swing too far. And the other thing is, like, I think people or some of these states think, like, if we clamp down on hemp, it will flow back into the legal market. And I don't think that's the case at all. If it's already a true adult legal market, some of it will. If it's a limited medical market like Texas, and they eliminated hemp, it's not going to go into their teeny medical market. It's not going to benefit them much. It's just going to go either across the border, people will go across by in New Mexico, or it's going to go back into the illicit market. So, I think it's kind of short-sighted on some of the regulators' point of view. They kind of think, well, if we clamp down on hemp, we'll force people into the legal market. And that's not the case. That won't.
No, that's that soccer mom that's buying the beverage to her door to have the Amazon experience is all of a sudden not going to be convinced to drive across town to the dispensary and wait in line. I completely agree.
Yeah,
with you.
and I mean, from my own point, like if I could get it delivered by Amazon to my front door, I would probably never go to a dispensary again. I'm sure there are other people that would agree with that.
Oh yeah, absolutely. Absolutely. Well, Frank, I promised you much less time than this. You've been so generous. Thank you. And I can tell you that, again, we're thrilled to have you on. And I would love to be able to ask you back on in a year's time. We'll check in on your big, bold predictions, and we'll check in on where we're at. So again, Frank, thank you so much.
Thank you. I really appreciate it.